Hi, I am Kadrian Shelton, co-owner of Baldwin, alongside Alyssa Fluke, Erica Carroll, and Sarah Hancock. To cover an overview of our company as of year one in 2018, our personal goals were to increase revenue by at least $20,000 per year and be at least third in market share with all of our products, specifically high-end performance and size. We've been together for 8 years, but in years 1 through 3, it was a bit of a rocky road. Baldwin accomplished at least third in our market shares, which was our first goal, but we quickly failed to increase revenue until year 4. In year 4, we retired some negative product lines, but we went back to a net loss in years 5 and 6. Year 7 is our biggest year thus far, earning us a net profit of $9.9 million. Year 7 earned back all of those net losses, ending with a cumulative profit of $1.3 million, which I think that we were very proud of. Baldwin's overall best performance was in the low end and the size segments. We ceased production in all the other segments just so that we didn't have to compete with Digby's existing products because we merged with Digby in year 7, which allowed us to combine our different strengths and collectively dominate a bigger portion of the market. Over the past 8 years, we had a cumulative profit of $4.3 million with ending sales of $61.4 million in year 8. Our highest net income was $9.9 million in year 7. Our stock price began at $34.25, initially increased, but it decreased as we faced all those contribution margin challenges starting in year 2020. As we began to resolve all those issues and eventually merge with Digby, our stock price increased, ending at $26.40 at the end of year 2026. Baldwin ended 2026 with an average contribution margin of 33%, which has steadily increased since year 2023 and ended 2026 as the second highest average contribution margin in the sensor industry. As a result of all of those challenges we faced in our merger with Digby, we ended 2026 with 2 product lines, which were Beat in the low end segment and Buddy in the size segment, which ended 2026 with an 18% and 11% market share, respectively. I think Baldwin is really proud of what we accomplished despite our dry season in the beginning years, but we picked ourselves up and we're excited to see what successes we accomplish in the future as a merged company with Digby.
To help us lower our labor costs and raise our contribution margins, we invested in automation for our factories. By year 2025, our market share was low and we were operating at a loss. When Digby came to us with an offer to merge with their company, we knew it was a good opportunity. They had good sales, held a high position in the market, and had consistently high profits in the industry. We had to think about how we would go forward from there. We considered trying to get back on top by ourselves, but unanimously agreed that it would be beneficial to team up with them. This ended up being the best choice, considering Digby ended up having the highest profit in the industry. Our biggest challenge was competing with the other teams. We had a hard time figuring out what their strategies were, the most difficult being who was staying in which market and how they would price their products.
Baldwin started out strong with a set strategy. Our initial long-term goal was to lead in the high-end, size, and performance markets. Yet, as time unfolded, we realized that our strengths favored the low-end and traditional markets. Our products, Bead and Baker, had high contribution margins from the beginning and a high customer survey. Our lack of knowledge and attention to these trends led us into a rut that would take us a while to get out of. By the time we came to this realization, we had already made decisions that would prove to be hard to recover from. Some of these decisions included the decision to completely pull out of the traditional market. The reason we did this was because our product, Baker, was losing us money. Although this was a result of our decision to not update Baker because our long-term goal was to phase out of the traditional market completely. By pulling out of the traditional market too soon, we missed out on the opportunity for greater sales in such a large market segment. A lack of investment in automation early on did not seem to have a large negative impact on our contribution margins at first, but eventually this showed to be true. By the time we realized that most of our contribution margins were lower than our desired 30% or above, we had already found ourselves in a lot of debt and net loss. When we finally realized how important it was to invest in automation, we were in a lot of trouble and a lot of debt as a company, which made it hard to finance investments such as this. Our high costs were contributed to our high levels of capacity. Because our products had lower contribution margins, we produced less, which ultimately hurt our sales as well as our bottom line because we ended up paying a lot of workers to show up when we didn't have anything for them to do. These internal issues combined made it very difficult for our executive team to stick to our long-term goals and to not operate year to year. The year 2023 yielded our lowest contribution margin at 21.7% and a net loss of $7.3 million. We knew that we had to make a lot of changes and that the investments in TQM and automation would be worth it. We acknowledged that we would not be able to fix our mistakes in 1 year, but were determined to see Baldwin succeed once again. We managed to lower our cost of labor and materials with these investments and increased our contribution margin by selling off products that were losing money. With these changes, we significantly decreased our overall sales. However, we were seeing an increase in ROS, ROE, overall contribution margin, net profit, and stock price.
Considering what we have learned over the past 8 years, we have developed a list of objectives along with specific action plans to achieve them. Our first objective is to increase sales by 10% per year. Since our merger with Digby helped to stabilize our financial situation, we are able to focus our resources and profits on increasing advertising and promotion. This will allow us to capture a larger percentage of the market share in segments with decreasing growth rates, such as the low-end market, as well as sell more total units in markets with increasing growth rates like the size segment. We will also invest in UNEP green programs and channel support systems to increase product demand. Our next objective is to decrease both labor and manufacturing costs. One of the biggest internal challenges we have faced was problems with our product's individual contribution margins due to high manufacturing and labor costs. Over the next 3 to 5 years, we plan to decrease these costs by investing in continuous process improvements, quality initiative training, and concurrent engineering Six Sigma initiatives. We also plan to achieve this objective by carefully monitoring capacity levels to stay away from using second shift labor, while utilizing as much of our factory capacity as possible. Detailed analysis of market trends and sales forecasts by our marketing team will allow us to more accurately predict how much capacity we need to add each year to maximize production efficiency. Another of our objectives is to achieve total market criteria expectations. A challenge that we faced was having to continually try and catch up with the position of our competition because we did not invest enough in the initial R&D for our products to perform as well as we expected. We also were not able to sell our products for most of the year because of the extensive R&D time that was required to make competitive adjustments. Over the last 2 years, we invested in concurrent engineering and quality function deployment efforts and have already seen a reduction in our R&D times. We plan to invest even more significantly in these areas over the next 5 years. These investments allow us to sell upgraded products that meet customer expectations for a longer time period. Our next objective is to increase accessibility and awareness to 90% for all products. We plan to achieve this objective by gradually increasing the promotion and sales budgets. Both products remaining in the market already have high awareness and accessibility levels. Bead has awareness of 69% and accessibility of 77% at the end of year 8, while Buddy had awareness of 67% and accessibility of 80%. Due to unexpected cash flows in years 3 through 6, we had to promote and advertise conservatively, but our merger with Digby helped to stabilize these fluctuations, and we are now in a position to raise the sales and promotion budgets annually to more competitive levels. Finally, we plan to introduce a new product in the traditional segment. Over the next 3 to 5 years, we foresee that the traditional segment is going to remain very profitable, making up between 20 and 25% of the total market. For this product to be successful, we plan to significantly invest in R&D upfront to give the product ideal positioning, as well as increase automation from the product's first year to decrease manufacturing costs in the long run. As Baldwin looks forward to the next 5 years, we are optimistic that we hold a strong position to both learn from our past challenges and take advantage of future market opportunities. We believe that our planned objectives and strategies will provide a pathway for a successful performance in the coming years. Thank you.